Hello and welcome to the Money Talk COVID-19 Daily Bulletin for Wednesday, June 10th. I'm Anthony Okolia. In a few minutes, I'll be speaking with James Marple, Senior Economist at TD Bank Group, about the latest Fed decision on interest rates. But first, a quick wrap of today's headlines. And we start with that decision. As expected, the US Federal Reserve left its key rate unchanged at 25 basis points, but signaled no further rate hikes through 2022. Canada's GDP will contract by 8% this year without a second wave of COVID-19, and 9.4% if a second lockdown is necessary. That's what the Organization for Economic Cooperation and Development is forecasting. The latest dose of bad news for investors in Starbucks. The coffee chain giant expects third quarter sales to plunge by $3 billion US due to COVID-19. Finally, streaming services will have new competition in July. AMC Theaters, the world's largest movie theater owner, announced that it is planning to reopen its 1,000 theaters around the world next month. And that's a wrap of today's headlines. Next, my conversation with James Marple. James, as expected, the Fed left rates unchanged at 25 basis points, but their tone was fairly dovish. They came out and said that they're not planning to hike interest rates until 2022. What was your takeaway from today?
Sure. Well, not a lot of change to the actual policy statement itself. The one thing they noted is that they would continue to purchase assets at least at the current pace, which to me indicated a bias to doing more rather than less. As you mentioned, the other big thing that came out of this statement was new projections from FOMC members on where the Fed funds rate they expect it to be, as well as on the economy, the unemployment rate, and inflation. I mean, I wasn't too surprised that they had those Fed dots right at zero all the way out until 2022. There were actually only two Fed members that had dots any higher than that. And one was, just above 0.25%, so not much of an increase. And the other one was just above 1%. So the rest of them just seeing rates on hold. But when you look at their economic projections, they have a 6.5% decline in economic activity, which is, of course, that's what all the other forecasts look like, but unprecedented outside of the Great Depression. And then a rebound in activity that isn't as strong as the decline in 2021. So it's going to take, in their view, and I think in the view of most people, a long time for the economy to get back to normal. And then on the inflation front, they had inflation actually not getting back to their 2% target by 2022. So all of that says, if you have unemployment elevated, you have inflation below target, you should be doing more rather than less. And we'll see. I mean, they didn't commit to doing anything more in this statement, but I would suggest that given their economic outlook, that's coming sometime in the future.
And I want to talk a little bit about inflation because we also got to look at May consumer inflation numbers, and is actually down in May, except for food prices. Do you think that the Fed moved aggressively enough to prevent the risk of deflation?
Well, I mean, it's a very difficult thing to say for sure. I mean, I think a lot of what we're seeing right now is a direct result of obviously the pandemic and the shutdown. So you've seen big price declines for things like travel and things like retail purchases, clothing and obviously food and anything purchased outside the home. Sorry, not food, but restaurant services and things like that. Obviously, if it's things that are purchased in the home, like food, like going to the grocery store, those things have gone up in price. And of course, that was exacerbated last month by the fact that you had a lot of meat plants shut down. So actually, meat prices were up extraordinarily high. I mean, I think in the near term, we have obviously a severe demand shock. We see that in a double-digit unemployment rate. But the inflation outlook obviously very highly dependent on, do we see the economy reopen? Do we see sort of a rebound as is even expected, I would say, in the economic outlook for the Fed? And if we don't see that, and maybe it's a bit too early to say for sure, and let's remember there's a lot of uncertainty even about the course of the virus, and are we through the clear in terms of actually bringing the caseload down? But if we are, we may be okay, and if not, then obviously the Fed's going to have to do more.
I want to get back to rates again. They said that no interest rate hikes until or through 2022. Are the fears of negative interest rates overblown at this stage, or is that still a risk?
Well, I would say that I think the Fed has been pretty clear that they see that as pretty down the list of things they would want to do in terms of policy rates. So, they have other options on the table. They could, for one, they could add additional purchases. They actually talked about doing that. At the same time, They could have forward guidance that ties the Fed funds rate to a specific target for inflation, or even average inflation, saying, look, we're under target and we've been under target for the last little while. We want to see an average rate of inflation, including this period in which we've undershot, get to our 2% target. And that's going to imply, rates of being low for an extended period of time. And the hope is that allows them to control the yield curve. Speaking of which, they could actually set out a target for the 10-year rate that they say, we're going to anchor it down at a specific threshold. We've seen the Bank of Japan do that. And I think all of those things are more likely than them actually taking the policy rate negative. Having said that, obviously, if we continue to see the economy depressed and we don't get back up to a state of normal, negative rates are a possibility. I would say, though, that negative rates are not congruent with what else we're seeing in financial markets. If we're seeing negative interest rates by the Fed, it's not a world in which you're at an all-time high on the S&P 500.
What are some of the key U.S. indicators that you're watching to see how well the U.S. is recovering from the pandemic?
Sure. Well, that's a great question, because some of the typical traditional economic indicators are now a bit lagged. Obviously, watching very highly the employment report, and everyone was surprised by the rebound in jobs that we saw last week. But a lot of attention had been on those weekly jobless claim numbers, and that's actually what misled people, because it only shows you one side of the equation. You knew a lot of people were getting laid off. What we didn't know is how many people were being rehired. But you can get a sense of some of that in some of these non-traditional indicators, things like mobility data from Google and even from Apple that shows, how foot traffic at places like retail outlets. And you see some of these other indicators, in the housing market, the number of listings and the number of showings have actually rebounded quite swiftly. You have weekly indicators of mortgage applications. So really some of those very high frequency data when we're looking for a turning point, that I think combined obviously with just watching policy announcements, what are states saying in terms of what businesses are going to be allowed to open up. And then hopefully you can combine that with some of those other data and eventually the hard economic data to get a sense of what different policies are going to mean for the economic outlook.
And I just want to wrap it up with a final question on the US dollar. Given that the Fed is not looking to raise rates for at least till 2022, where do you see the US dollar going over the next little while?
Well, I think probably nowhere fast, but I mean, obviously that depends on the relative which cross we're talking about. If we're talking about Canada, I mean, there's some reasons to think potentially the Canadian dollar could improve. I mean, we've seen obviously the oil price outlook improve a fair bit, and we've seen supply cut very dramatically, and that could lead to some improvement in the Canadian dollar. I think also, we've seen some solid success in Canada in terms of moving case counts down. And so again, the course of the relative health outcomes, I think, could be something that even drives market outcomes for things like exchange rates.
James, thank you very much for your time.
You're very welcome.